Welcome, welcome, welcome to another edition of Wealth Strategies Unleashed. I'm Robert Gilliland, and with me today we have the talented.
Mike Alexander.
Let's talk about growth versus value. There are two different types of stocks generally. We call that their style. Either they're growth stocks or they're value stocks. And a lot of times, and what we're starting to see is more and more people are overweighted to one over the other. And that tends to happen in a cycle. So to kind of go through and start off, give us a real simple third grade definition of growth stocks and value stocks.
So the simplest way you can perhaps think about it is think of growth stocks as being those types of companies or stock in those types of companies where they are growing their earnings faster than the broader marketplace. So sometimes growth stocks are called momentum. Sometimes they're called growth at a reasonable price. But essentially, when people think of growth stocks, a lot of times they think of the technology names.
Right.
They think of some of those the Magnificent Seven type names. Those are the types of things that they typically think of when they think of growth and growth stocks. Value stocks are those companies that typically trade at a discount to the broader marketplace. So they are more associated with companies that pay dividends or pay rising dividends. And there's also some room in between growth and value for companies to kind of match both. They pay a little bit of a dividend, and they grow a little bit faster than the marketplace. And so they kind of fall in that, what a lot of people would call that sweet spot between the two. Historically, one of the biggest differences between the two is the level of volatility of each one and the amount of risk associated with each one.
I always tell people that think of it in emerging stage of the business cycle. They're not paying a lot of their dividends. They're reinvesting their earnings back into their company. Generally speaking, those would be your growth stocks. The great example is pick a tech stock. Stocks in a more mature stage of the business cycle have good earnings, pay a portion of that earnings to shareholders. Those would be value stocks, kind of older type companies. So, but how should you set a portfolio up? How much should you have in growth and how much should you have in value?
Yeah, so what it really comes down to is it comes down to risk tolerance. And historically, you could make the case that risk is associated with the equity market in general. We all know that. The degree to which a company returns a lot of its earnings back to shareholders in the form of dividends typically leads to a lower level of volatility over longer periods of time. Now, that doesn't mean that's always the case, and it doesn't mean it's the case on a short-term basis, but over the longer term, you typically see lower levels of volatility with companies that are returning value back to the shareholder in the form of dividends. When it comes to portfolio construction, I think it's important to recognize, where are we in the business cycle?
Right.
What is investor appetite for risk when volatility is low? A lot of times you'll see companies that are more growth oriented tend to outperform. We've been in that kind of period for the better part of the last several years, where you have a handful of stocks kind of leading the way. It was no different in 2024. In 2025, kind of a similar beginning, if you will. But that doesn't mean it lasts in perpetuity. One thing that I think you can think about as it relates to the economic cycle is to think of growth this way. When there is an absence of growth or a shortage of growth in the marketplace, it's actually growth stocks that typically lead the way because growth is harder to find. And that sounds counter to the way that you would think about it. But when growth is harder to find, people will pay more for companies that actually are growing in that environment. And it's when you see a broadening of the economy or you see an environment where economic growth is is very prevalent, that you'll start to begin to see value-oriented stocks or the broader market actually participate in that. And I think that's one of the things that we've witnessed over the last couple of years, is that it seems like every year as we enter into the year, that investors are worried that we're going to have a recession, that economic growth is going to slow, that interest rates are too high and it's putting pressure on growth. The result of that is that every year we've had, kind of in stops and starts, we've had this period where growth stocks have outperformed, and that's been the case this year. I think if this past year certainly, where the growth part of the marketplace. So let's just think of the NASDAQ, if you will, has outperformed the Dow Jones Industrial Average, which is more value oriented, and it's outperformed it by over over 10 full percentage points.
Right. When the way that we've always viewed that is, you go through and you think about this growth, value, and they tend to zig and zag opposite of each other. And what you can end up doing is, if you have a relatively decent balance between the two, you're going to split the difference and do pretty well. The thing that's interesting, when I think back to 1998, 1999, and what was kind of going on, people only wanted to have what we would consider growth stocks, and they didn't think there was any risk. And then the tech bubble pops, because at that time, the vast majority of them were growth stocks. I don't know if we're anywhere near that right here, right now, but we all kind of get what sectors are growth oriented. Technology would be one. What are some other kind of growth sectors?
Yeah, a lot of other growth sectors would be tied to things like communication services, consumer discretionary names. So when you think of communication services, you think of things like, like Netflix, for example, is a good example of, it's in the communication services, or Google, Alphabet, if you will, would be another name that is associated with that communication services name. When you think of consumer discretionary, you're probably thinking of names like, like Amazon, like Tesla, like some of those areas. Those are just, I mentioned some of the larger names because those are the ones that really have been driving a lot of the market performance in some of those names. On the other side of that, when you think of value names, you typically think of energy is a good example of that. There are names in telecommunication services like Verizon or AT&T that might be more value-oriented names. Companies that typically are very capital or people intensive. And so one of the things that you can perhaps keep in mind as you think about the nature of some of these companies is, the more value oriented names tend to be the types of companies that have they have tens of thousands, if not hundreds of thousands of employees. They're very labor intensive. Perhaps they're in manufacturing or production. When you think of technology names, you think of getting in the growth side, you tend to see companies that maybe are less labor intensive. They have employees certainly, and their employees are well paid, but there's a tremendous amount of productivity that comes from those types of companies in terms of, how that versus how many employees they have.
There's a lot of people who think that because they've hit a certain age that they want to live off of dividends. What are some risks with regard to dividends, value stocks that we need to be aware of?
Yeah, so there's a reason why a company is a value stock, right? When we think of value, we think cheap, right? And when things are cheap, there's typically a reason why they're cheap. It may be because there's no place for them to invest some of the cash flows from the company. There's no growth mechanism associated with the marketplace. And so the result is that you wind up trying to deliver the value back to the shareholder in the form of dividends. One of the things that's changed, if you go back over the last, let's just say you go back over the last 30 or 40 years, is that 30 or 40 years ago, people did not derive as much of their income from dividends as they actually do today. And part of that has to do with the bond market, and we could certainly talk about that. But the reality is that when companies start struggling to find places to invest for future growth, they typically will begin to return some of the shareholder value, if you will, in the form of dividends. One of the things that I would tell you, and this is really more on the opportunity side of dividends, is that we've seen a record number of companies actually raising their dividends, and I think that's a good sign. If you think about the return that you get on an investment, it's really the income that you receive from it, meaning the dividend, plus or minus any capital appreciation or depreciation that you might see in the marketplace. Clearly, the risk, as you mentioned, is that the company really can't grow, and eventually they're not earning enough money to actually cover the dividend that they're paying, and they wind up having to slash the dividend.
Right.
To invest back in to try to regrow the business. A good example of that would be Intel, which is it at one time was an absolute darling of Wall Street. It was a very fast grower. They started paying really, really good dividends and perhaps didn't reinvest in AI when they should have. And then the result of that is not only did they see have to slash their dividend, but they saw a diminished share price as well. So they kind of got the double whammy.
Yeah, that has been tough for shareholders of
And now it's a value stock. So it used to be a growth stock. Now it's a value stock.
The thing that I think about is that there's always that risk when you're looking at the yield on your money. And the one thing that when you go to look at a stock price, or any sort of investment, right? There's two things you have to take into account. And that is, one is your appreciation in value. You buy it here, you buy it at 100 and it goes to 110. The other, and you look at it from the standpoint of your total portfolio. So it's not just on that one individual stock. It could also include the income streams that come off of it. Well, it might go from 100 to 108, but it pays 2% dividend. That's equivalent to being 110. They're the one and the same. And I think that people need to balance the two. Growth stocks will tend to obviously be more volatile, but should get you higher returns. But the reality is consistency of your returns is far more important, because then you end up with time bias. Mm-hmm. Right. And so making sure that you're looking at it in the long term. One of the things that I think about, because what ends up happening is, and we see this all the time, people's portfolios get overweighted to one style or another, whether that's growth or value. And kind of as the last question, what would you say is, when should people rebalance between growth and value?
Yeah, so I think there's a couple of things. It's not uncommon to see people just rebalance on an annual basis. Sometimes it's on a semi-annual basis. Sometimes it's on a quarterly basis. But perhaps as opposed to looking at the calendar to decide when to make that rebalancing decision, it might be better to look at the value of the portfolio. And when one becomes 5 to 10% overweight versus the other, is typically a good time to go back and rebalance a portfolio.
So you have these bands, right? Mm-hmm. And that's the hardest thing, selling winners and buying losers. Now, we're not saying that if you have company A and it's completely going and running, and you have company B that is a dog and there's something fundamentally unsound with that company, that doesn't mean you go and continue to load up on that company. We're really talking broad markets here, not individual companies. But that's the toughest part. Selling the winners or reallocating to things that maybe aren't performing at sectors or industries. Well, I guess that's one of the same. Or styles. Right.
You have to think of things like taxes and what are the tax ramifications of doing so. I think as we've talked about a lot, Robert, it's one of the reasons why we've always liked dividend growers, because not only are they raising their dividend on a regular basis, but a lot of times companies that have the ability to do that are seeing increasing cash flow, which means
Right.
they're also growing as well. And so that's kind of that sweet spot of the marketplace. There's nothing wrong with buying, companies that have really high dividends, but you just have to make sure that, that they're earning enough money to continue to cover that dividend. Otherwise, the dividend becomes at risk. And by the same token, there are companies that, all you're counting on is the growth. And if they have a competitor that comes into the marketplace that undercuts them, sometimes that all of a sudden inhibits growth. And I think one of the things that we've seen as companies announce earnings is that yes, it's great when you hit your earnings number or you hit your revenue number, you guide investors to a better outlook going forward. But we've also seen the opposite of that, and that is if you disappoint the market and valuations are high, you can really get punished. We've seen companies lose 20 to 25% of the value of their entire franchise in a day simply for missing earnings. And so again, that's kind of that striking the proper balance between growth and value, owning both, and then making sure that you consistently, rebalance those two.
Awesome, Mike. Well, I hope everyone found value in this. Anything else that you would go and add?
I think as we kind of roll through 2025, pay attention to companies that are raising their dividends. Again, we've seen a record number continuing to do that. And I think that's a positive for investors. I think it's always beneficial to get paid while you wait. And that's kind of what getting dividends are, especially when you have companies that are raising their dividends. So don't forget those.
That's right. But also, when you find a company that has that's dividend yield is 9-10%, understand that's not a riskless transaction. There's a reason why they're paying that much.
If it sounds too good to be true, a lot of times it is.
Well, Mike, thank you very much. I hope everyone found some value in this, and we'll see y'all next week.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.